REITs are a pretty popular investment for certain investors that prefer to invest in real estate, or someone who prefers to diversify into alternative investments outside of like traditional stocks and bonds. Are REITs the right investment for you if you want to achieve financial independence? Maybe, maybe not. That's why we're going to run down some of the pros and cons when it comes to REITs, and specifically how it compares to when you're trying to achieve financial independence. Make sure you stay to the end because I have a long-term comparison over the returns of REITs compared to the overall stock market. Now, the short answer I just want to get out there really quick is that I actually personally do not currently have any significant portion of my portfolio directly invested in REITs. And by the way, I haven't said it yet, REITs are real estate investment trusts. To try and simplify it as much as possible, you can think of it as a mutual fund that holds real estate. Now, the rules for REITs and mutual funds are a little bit different, but they are similar in the way that they hold multiple different types of assets within like one organization, like within one entity, and you are buying that entity, you're getting a share of that entity, and therefore you get a profit. If that entity makes a profit, you get your share of those profits from that investment trust. Now, when we're discussing the pros and cons, the first thing that I want to talk about is a pro. And a really great pro of REITs is that it's a super passive way to invest in real estate. All you really need to do is give up your money, buy this real estate investment trust, and you're going to be able to share within the profits of that trust. Now, that's a really easy way to get invested in real estate. Pretty much any dollar amount you can get started with, you can invest in a real estate investment trust with very little money, and therefore you don't have to have a significant amount of capital like you would like in traditional real estate investing. Like if you were going to buy a rental property nearby where you live, you're going to possibly need hundreds of thousands of dollars in order to get started. And the real estate is managed all by someone else or some other company, and therefore you don't have to get any kind of landlord status going on there. So it's completely passive when it comes to investing in REITs, and obviously, in my opinion, that is definitely a pro. Now, there is a significant con that I do have to discuss as well, and that is taxes. Taxes play into all of our investments, and they are a very important part of realizing what you're getting invested in and how that investment is going to return and how that investment is going to do good for you. So when it comes to taxes, real estate investment trusts have maybe a good thing if you're looking for cash flow, or maybe a bad thing if you don't want or need that cash flow right now. So real estate investment trusts, they must pay out 90% of their profits to the shareholders of the REITs. So they must pay that profit out. It must get passed on. And what that means is that all the profit that gets passed on, 90% of it at least, is going to go on your tax return in that year, and then you're going to have to pay taxes on that real estate investment trust income. One problem with this, unlike for say a stock that pays a qualified dividend, which is going to be taxed at a qualified dividend tax rate, which is the long-term capital gains tax rate, REITs, when they pay out their dividends, it's not like that. They don't get qualified dividend status. So you're going to be taxed as ordinary income with the income that you receive from investing in REITs. So that profit that's passed on to you, it's going to be taxed as ordinary taxable income. And that's why one way that you can kind of circumvent this con when it comes to REITs is to make sure that you're putting them into tax advantage accounts, such as an IRA or a 401k or something like that. Ideally, you wouldn't want to invest in REITs in a regular taxable account because they have to pay out those dividends and because they're not going to be qualified, so the tax status is going to take away from your return in the long run. And so if you have it invested in like an individual retirement account, then you're shielded from all those payments, and you're not going to be taxed on those wallets within the account, and that is definitely a good thing, and that's one way that you can circumvent this con when it comes to REITs. Now let's go into another pro when it comes to REITs, and that is that they are really good at hedging against inflation. And that's because in general, generally speaking, real estate itself is good at being a hedge against inflation. However, stocks are also a pretty good hedge against inflation. All of these pretty much have to keep up with inflation, and usually a little bit more than that when they are going to appreciate. Unlike when you're investing in bonds, which is debt, usually at a fixed interest rate, there isn't as much inflation risk when it comes to investing in REITs because REITs invest in real estate, and real estate is generally a good inflation hedge. And so if you're investing in REITs, that is one really good thing that can really help you, especially when you're on the path to financial independence, because inflation is one of those things that you definitely need to look out for, especially in the long run. So that's why it's really important to invest in things that are going to hedge you against inflation. And REITs is one way that you can do that. Now, going back to the con of REITs, one con that I kind of see here is the growth. So it's really hard, or they have to do it in a different way. They have to grow in a different way. Going back to before, REITs must pay out 90% of their profits. that means they can't put all of those profits back into the investment trust and back into more real estate. And so they have to raise capital in a different way. Whereas a company, like a stock, they could just take the profits, and instead of passing on to the dividends to their shareholders, which they don't really do unless they're really big and already established, many of the companies that we invest in, like in the S&P 500, they actually take their profits and don't pay out any dividends or very, very little dividends, and they just reinvest it into the company and try to grow the company more. But real estate investment trusts, they can't really do that since they're required to pay out 90% of their profits. And therefore, most of the time, in order to raise some capital, in order to grow more, they must use leverage, and that means they must use debt. They must take on more debt. And with leverage, sometimes comes increased returns, but also comes increased risk. So that right there increases your risk, because technically the investments that you are buying into, they are becoming leveraged. And so real estate investment trusts can have significant amount of leverage that's utilized in order to raise capital and to invest more in it to grow the investment trust. Or another way that they can do that in order to raise capital is known as diluting their shares. So they can dilute their shares by basically adding more shares, and so that they can get more people to buy it, and they can raise some capital and to invest anymore. And so they decrease your ownership, the percentage of ownership, because if you add more shares, that's going to dilute all the shares, and so you're going to have a smaller ownership within that real estate investment trust, and they're going to be able to raise more capital by selling off more shares. And this is what they must do in order to grow, since they have to pass on those profits. And in my opinion, that is a con when it comes to growth, because it is harder to grow. You must grow by leverage or by issuing more shares, whereas a company, a regular stock, they are able to grow by also just reinvesting the profits that they have. However, we can go ahead and go into another pro, and this pro is very similar to a con, because it is the opposite, which is a good effect of this actual con. So the con was that they have to pay out 90% of their profit. That is also a pro if you're looking for some cash flow, if you're looking for some income. And so the pro is going to be their dividend rates, or their payout, how much they actually pay out. So for example, a very popular kind of like an index fund kind of thing when it comes to a real estate investment trust is Vanguard's VNQ, and that is just a Vanguard real estate ETF. We can compare the specific dividend rates to the Vanguard ETF to VTI, which is the Vanguard Total Stock Market Index, which is what I personally invest most of my wealth in. And the dividend rates for those are as follows. So VNQ, the real estate, they pay a dividend rate, at least in 2020, of 3.65%. Whereas VTI paid a dividend rate of 1.71% in 2020. So that is, pretty significant amount of dividends if you are looking to get actual cash flow from those dividends. So if that is your main goal, if that's what you're looking for, then obviously the real estate pays out more dividends, because in most circumstances, if they are a real estate investment trust, then they have to pay out 90%. And an actual REIT might be paying even more than that. It really just depends on what sector of real estate you're going for. If you're investing in a broad real estate investment trust, you can see much higher payouts in relation to percentages. You can see, maybe as high as 5%. And it just depends on the year, of course, when real estate is doing good and when real estate isn't doing so well. However, there is one more con that I do want to mention here when it comes to REITs and financial independence, and that is the interest rate sensitivity that REITs are going to have. Because obviously, since they are using a lot of leverage, that means that the interest rate plays a really big role in how they are going to be performing. When interest rates are low and leverage is cheap, they should be performing better. But when interest rates rise, then the cost of leverage is going to go up, and therefore it might be a little bit more difficult for REITs to have better returns. And right now, at least currently while I make this video, interest rates are as low as they'll ever be. Probably they're super low. I don't know how much lower they can get than that. And so real estate investment trusts are probably doing pretty well getting all of that cheap leverage right now. But what happens when the interest rates can only go up? Something is going to happen, and it's going to affect REITs definitely, because it's going to increase their cost of leverage. Now let's get to the really fun part, and that is comparing REITs to the total stock market. But before we move on to that, make sure that you like this video, give it a thumbs up if you are enjoying it so far. I really do appreciate that, and it really does help me out. It helps the YouTube algorithm know that you support this video, and they will go ahead and show it to more people, because trust me, more people definitely need to see this video. Now, the first thing that I want to talk about is the correlation to stocks. Okay, so correlation is pretty important when you are comparing two different types of investments. And for correlation, I'm going to use from January 1997 to June 2021. So that's the oldest data that was available for this, using an online tool known as Portfolio Visualizer. So according to Portfolio Visualizer, there is a 0.44 correlation between the Vanguard Real Estate ETF and the Vanguard Total Stock Market Index. So if there were a correlation of 1, that would be perfectly correlated. That means they move in sync. If there is a correlation of 0, that means there is no correlation. So 0.44 would mean that there is moderate positive correlation. So there is moderate correlation between these two funds, but it is not perfectly correlated. So at 0.44, it is just moderately correlated. And within that same time period, Portfolio Visualizer gives us the return on investment of the real estate versus stocks. And for real estate, it has been 8.74% for that particular fund. And for stocks, it has been 9.16%. However, we also have to look at the volatility. So the volatility, which is also commonly referred to as risk in many circumstances. So the risk of volatility is 20.02% for real estate volatility and 15.93% for stocks. So technically over that period from 1997 to 2021, stocks have performed better and with less volatility, which is kind of hard to wrap your head around, right? Because generally speaking, we think of real estate as being less volatile and we think of stocks as being more volatile. But of course, you can always pick time periods where one is probably going to be less volatile than the other and where one is going to return more than the other. So there are definitely lots of nuances to this. I just used the oldest available data that was within Portfolio Visualizer, from 1997 all the way up until 2021. And it just so happens during that long time period that stocks performed better and they also had less volatility. Now, with that being said, that leads us to the question, should you invest directly into REITs? And the answer is, I don't know. No one knows the actual question of should you do it. Maybe you should, maybe you shouldn't. Just like with any other investment, there are pros and cons, and you have to look at what your investment style is, what your investment philosophy is, how much risk tolerance you're willing to take, what you can relatively expect the future to be, because as we know, even though in this scenario the stocks did win, past performance does not equal future performance. And that is just something that everyone is required to say by the SECs. But regardless of what you choose to invest in, one thing that you really do need to do is you need to watch another video that I created. It's a full guide to investing your way to financial independence. If you haven't watched that video already, make sure that you watch that video. Now, thank you so much for watching this video. I'm Zach from uncashflow.com, and I hope to see you next time.